but it has been a pretty incredible market run. You think it's surprising, don't you?
I do. I mean, look, obviously we've had this massive run off the December lows, and it does not stop, right? As you just mentioned yourself, 7 weeks, almost no down weeks for the NDX since the very beginning of the year, and I start to wonder about the structure of it all, because yes, we knew we had the Fed turning policy, and yes, we had, you know, obviously a lot of jawboning from the side of the administration about a China deal, but how many more times can you price in the same news item? Google, you know, stocks rising on positive trade rumors, and you get dozens of responses. It's basically the same thing over and over. And so what I'm seeing structurally is actually a market that keeps gapping up on ever decreasing volume, and that raises some questions about how long this is viable. But clearly it has to recognize, as long as this keeps going like this, it can keep going.
What to me is truly incredible is that it's not just our stocks. It's not just global stocks. It's not just bonds. It's everything, most commodities, all stocks, bonds, they're all higher. I guess my fundamental question is, and I don't even know if you can answer this, Sven, is where's all this money and where are all these buyers coming from?
Well, it's a very, very interesting question, because actually when you look at fund flows, they're actually negative, especially from the retail side. What we have had this year, this quarter, is obviously record buybacks again, to the tune of $270 billion. And keep in mind, this is kind of this running artificial liquidity program that's been running since the beginning of 2018. We've had 5 quarters of over $1 trillion in buybacks. And when you have a low volume environment, that tends to obviously exacerbate, especially look at the structure of the market intraday. Typically what we saw it again on Friday, right? We had a gap up, and then markets stayed in a very tight range, and the gap never gets retested. And so since beginning of the year, we've now had 7 unfilled gaps on the S&P. Gaps can remain unfilled, but the more you keep building them, the more at risk a rally becomes subject to a technical reversal.
Yeah, I mean, I talked about the NASDAQ 100, very widely watched index as well, has one down week all year. Technically, Sven, is there any sign that this market, the U.S. stock market in particular, is going to peter out?
You know, Brian, I remember you coming here to London, and we sat in this very studio here last summer, and we were talking about some of these divergences and the fact that some of the tech stocks, it was just a really thinning leadership in terms of who is driving the market. And we see some of this exact same thing now. Basically, for example, in the Q1, the NDX was driven, 35% of the gains came from 3 stocks, Apple, Amazon, Microsoft. And if you look at the chart here, now you see a pattern structure that's very similar to last summer, right? We had the steady lift up on gaps, on low volume, and this is called a rising wedge pattern. And last fall, that wedge pattern broke to the downside, and it released a lot of energy. And we're seeing a wedge now that is basically replaying the same thing, except it's even steeper and it's even becoming more narrow. At the same time, we have volatility compression. So as I said last summer, these patterns can continue, but watch when they break, because that's when you see a punch coming out of the volatility compression.